and welcome back for another episode of our Ultimate Lease Accounting series. So last video, we walked through the practical expedients available to ease your ASC 842 transition. During this episode, we will define lease modifications and discuss the differences between a lease modification and a reassessment. We will also go through a straightforward modification example to help illustrate the new accounting treatment under ASC 842. Let's dive in. ASC 842 defines a lease modification as a change to the terms and conditions of a contract that result in a change in the scope or the consideration of a lease. Some of the more common examples of modifications are additional asset rights, lease term extension or reductions, partial or full terminations, and changes to the lease payments. The proper accounting treatment for a lease modification depends on the nature of the modification. ASC 842 specifically distinguishes between two types of lease modifications. The first type are lease modifications that give the lessee additional rights not included in their original lease, extend or reduce the term of the existing lease, or change only the consideration in the contract. And then the second type of lease modification is one that partially or fully terminates a lease by reducing the lessee's rights to use one or more of the underlying assets. So in this video, we'll concentrate on the first type of modification and talk about terminations in the next video. Once you are aware you have a modification, first determine if the modified contract is in fact still a lease. Then determine whether the modification should be accounted for as two separate leases. A modification is accounted for as two separate leases when both of these following criteria are met. One, the lessee receives additional rights that weren't outlined in the original lease, and two, the payments increase proportionate to the standalone price of the additional asset rights, adjusted for any circumstances of the particular contract. So what this means is the additional rights could be leasing a new floor or some co-joining space in a building. If the landlord offers these new rights at a 10% or maybe even 15% discount, this takes into effect the circumstances of the contract. The landlord is passing on some of the savings they receive from not having to find a new lessee. But on the other hand, if the landlord offers the new rights for $1 or at a significant discount to the market rate, or on the flip side, a significant increase to the market rate, this will not meet that market rate criteria, and the additional rights would be a lease modification and not a new lease. So to recap, if the change meets both of those criteria, then it will result in two separate leases. The original lease through its original terms, and then the new lease, which is going to result from the modified terms. If the change does not meet the criteria for new lease, then you would just account for the modification. And then also one other note here, if the modification grants the lessee the right to use the asset for an additional period of time only, that modification is not going to create a separate lease contract. If you think about it, this is because while the extension may allow the lessee to use the asset for longer, it doesn't actually grant the lessee additional rights, so there would not be a new contract. From ASC 842, examples of modifications not resulting in a new lease contract include additional rights that aren't a separate contract, the extension or reduction of a lease term other than the exercise of contractual option to extend or terminate the lease, a full or partial termination, or changes in the consideration of a contract only. These will not result in a new lease contract, but they will require remeasurement of the lease liability and right of use asset. Whereas a lease modification is a result of a contract renegotiations, a lease reassessment is a result of a lease change event that does not involve renegotiation of the lease terms and conditions with the lessor, but it does change the lessee's facts, assumptions, or other circumstances related to the lease. Here, the FASB aims to create lease guidance that did not continually require lessees to reassess their leases. In an attempt to limit the need, the guidance specifies when it is appropriate to reassess a lease. Paraphrased from ASC 842, the lease term and the likelihood of a lessee exercising a purchase option are only reassessed when one of the following occurs. An event written into the contract causes the lessee to exercise or not exercise an option. A change in the election or non-election of an option occurs, or a triggering event occurs, whereas the triggering events are thought as an event, a significant event or significant change in circumstances that is both within the lessee's control and directly affects the assessment of whether the lessee is reasonably certain to exercise an option. Some examples of triggering events are constructing leasehold improvements, subleasing the asset for a period beyond the lease term, or significantly modifying or customizing the asset. With the significant leasehold improvements, maybe you've done those a year before the lease is up. If they're, of great cost, chances are you'd have the lease longer than just the 1 year remaining on the term and renew it. So examples of reassessments are changes in the lease term, purchase option assessments, residual value guarantee amounts, or the resolution of a contingency. So given that lease reassessments could potentially have a material impact on a lessee's financial statements, you may want to consider implementing new processes and controls to monitor and account for any significant events or changes in circumstances like triggering events, the exercise of options or a decision not to exercise an option, and events specified in the lease agreement requiring the lessee to exercise or not exercise options. This effort will need to involve cross-functional coordination to ensure timely identification of events requiring revisions to lease accounting. In general, accounting for a lease change without a requirement to reassess the lease classification and update the discount rate is a pretty straightforward exercise. You revalue the lease liability to equal the present value of the updated payments. Then the lease liability adjustment is offset by an equal adjustment to the right of use asset. Unless the carrying amount of the right of use asset is less than the adjustment amount, then that difference will be recognized in the income statement as gain loss. The lease liability is remeasured with an updated discount rate only if the remeasurement is due to a change in the lease term or a change in the lessee's assessment of whether it will exercise an option to purchase the underlying asset. If the lease liability is remeasured for another reason, then the discount rate isn't updated. Okay, so we just went over a lot of facts about lease modification and lease reassessment. Let's just recap that a little bit. Modifications and reassessments both result in the remeasurement of a lease liability. However, the type of event dictates the additional treatment, such as whether the discount rate should be updated at the time of the change, whether the lease classification should be reassessed, or whether the consideration in the contract should be reallocated. In summary, lease modifications are identifiable as a change that requires contract renegotiations between the lessee and the lessor. When you have a lease modification, the appropriate accounting treatment is to adjust the payment information, update the discount rate, and reassess the lease classification. Reassessments, on the other hand, are required when an event does not involve renegotiation of the lease term and conditions with the lessor. But when a change in the lessee's facts, assumptions, or other circumstances related to the lease occurs. As an example, a lessee may change its conclusion on the certainty of the exercise of a purchase or renewal option. This table is a great summary or representation of the common lease events and their proper accounting treatments. Now let's walk through a straightforward modification example to help illustrate the appropriate accounting treatment. So the assumptions in the example are as follows. We're going to have a 10-year lease with annual payments made at the end of the year. of $100,000 with 3% escalations. The lessee has an incremental borrowing rate of 6%, and we're going to assume this is an operating lease. So taking all of those facts and circumstances, we come up with total cash payments of $1.1 million and an annual lease expense of $114,000. And then lastly, a present value of $831,000. So here's the amortization table. We have the lease liability and the right of use asset amount as the $831,880. And then we also calculated the total lease expense of the $114,639. So we can create an amortization table that decreases the total lease liability and the right of use asset to zero over that 10-year period. And then from the amortization table, here are the journal entries for the lease. First, here is the initial recognition entry for the lease, which is going to put the lease liability and the right of use asset on the balance sheet at that $831,880 amount. And then you have the annual lease payments. We said that that payment, the first payment for the first year was $100,000. Your lease expense is going to be $114,000. And then you also have the corresponding decreases to the operating lease liability and the right of use asset. So let's say at the end of year 5 of the lease, the lessee and lessor agree to the following modifications. They're going to extend the lease by 5 years. The year 6 rent payment is now going to be $150,000. We're still going to have a 3% escalation, but just starting again with the $150,000. And then as of the modification date, the new IBR is 7%. And lastly, we're going to assume that this is an operating lease again. So on the previous slide, we laid out that the lease is still an operating lease and that the lessee's new IBR is going to be 7%. So the next step is to remeasure the lease payments. Here's the payment schedule, starting with $150,000 in the 6th year. We added on 5 more years. So we end up with an updated lease payment amount of $1.7 million and an updated present value amount of $1.188079. So this is going to be your new lease liability. You take that against the lease liability balance at the end of year 5 when you made the modification and calculate the adjustment to the lease liability and right of use asset. In this case, it's going to be the 188 minus this 516 for a change amount of 671,340. So now we have the adjustment for the lease liability and right of use asset. We know the cash payments. We need to figure out the total lease expense. Now this is a little different. The new total lease expense is calculated as a total of the updated payments. So all 15 years of the payments, and that's going to be divided by 10 years after you subtract out the payment amounts that you already made. We'll go over that on the next slide. So see here, the updated total lease payments are $2.2 million. You take the first 5 years and the next 10. Subtract the previously recognized lease expense, which in this case was the 5 years of the 114. That difference is going to be $1.6 million. And then that's divided by the remaining amount of the lease, which is 10 years. So we get the new lease expense is $167,730. So we completed the amortization table with the modification calculations, and now we're ready to create the journal entries to record the modification. You first have the entry to record it, which is just the adjustment amount of the $671,340 as a debit to the right of use asset and a credit increasing the lease liability. Then you go to the payment entries. This is going to be the new payment at the end of year 6. We have the new $150,000 cash payment and the new lease expense of $167,730, and then the decreases of the operating lease liability and right of use asset that were calculated from the amortization table. And there you have it. That's how you calculate and account for a lease modification.